the same time, I'm not sure if the Fed cuts rates aggressively, whether that will help bring down longer term yields. And even if there is a deep recession, a lot of people expect long term yields to drop. But I think they could be wrong, because the big beautiful bill bet everything that the economy would pick up, so that the deficits that it's supposed to translate into could be covered easily. But if the economy doesn't pick up and you've got this huge deficit and borrowing, it could be catastrophic. Wednesday, July 30th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, I think the stars are aligning for a major reset on the part of the United States. And that's what we're going to focus on today. Before I go further, some of you have complained about the volume in my videos. Someone even said after you refurbished your studio, the volume is gotten worse. Well, it's got nothing to do, of course, with the studio, but maybe it was with the fact that I got a new phone with which I record, and my old microphone didn't fit in it. So what I've done is I bought a similar microphone that is compatible with the new phone. So let me know if it's sounding better now. And yeah, back to the main topic and why I think the stars are aligning for a probable reset. And I've spoken in the past that the reset is ongoing, and I think it's been ongoing since the beginning of this century. And why is that? Well, because if you look at the Dow Gold ratio here, ever since 1999, 2000, when the stock market topped, we had the dot-com bubble, the Dow Gold ratio has been in a downward trend. And in my opinion, that's part of the reset from paper or financial assets to hard assets. It's been a very slow slog, so to speak. And there have been people who predicted that the Kondratiev curve was pointing to a depression after the turn of the century. And I think we are in a depression. And you might be asking, what are you talking about? Well, if you go back to the 1920s and 1930s, the dollar was as good as gold. So everything was measured in terms of gold. So the fact that the stock market is down since the year 2000, bonds are down, a lot of things are down. It means we have been in a deflationary environment in terms of prices, of course. The reason why it doesn't feel like a depression is that unlike in the 30s, we have a system, or actually non-system, fiat currency, where governments and central banks can just inflate things out of thin air. And that's what they've done. And that's why for the people who have assets, it's been the best of times, of course, because their assets have become worth more and more. We've had a stock market bubble, even a bond bubble, which is, in my opinion, finished. You've had a fairly good commodity upcycle, especially in the precious metals. The general commodities have been a bit more cyclical, but I think they're ready to resume their move higher. So we're getting to a point, though, because of geopolitics, that the debt is getting so huge, and the deficit spending getting so huge in the US and other countries like here in the UK. And we've alienated foreigners who help us finance this debt. And we've got a foreign nation as well named Japan that's been helping the West do this as well, keep us out of this depression that we're in nominal terms at least, through money printing, through zero to negative rates. But now Japan is like really in trouble, and the rubber has hit the road, so to speak, in Japan. They've got 250 or so percent of debt to GDP, national debt. The BOJ owns more than half of all JGBs. That market is totally kaput because they've destroyed that market. There's very little liquidity, and I've seen here today a post from Dario, who I interviewed, and I posted the interview yesterday, and I highly recommend you watch that interview. I'm going to put it here again in the cards. Well, he just posted, all right, folks, this is a pretty big red flag. If these interventions are needed on a daily basis, now something pretty serious is happening behind closed doors in Japan. BOJ to lend government debt on spot morning offer. And I think he also posted a bit before that post. He said, how long will it be? Will the BOJ be able to avoid the collapse of a major financial institution? So there's problem in Japan, and I think there's problem in the US in terms of the economy as well. I'm seeing a lot of people who are very good analysts pointing to the fact that we're going into recession in the US, and there's a lot of indicators. For example, this first one here, the job openings, they're declining rapidly, as you can see here. Bravo's research posted this alert: job openings have been falling off a cliff. And you can see that when job openings start falling, you're in the middle of a recession. So how come this doesn't recognize a recession so far? Well, I think it eventually will. So that's a really bad indicator. This is another one here. This came out yesterday. And it's one of the reasons why the Trump administration has been pushing Powell to cut rates, even though I'm not sure that will be the solution to bring down mortgage rates and longer-term treasury yields. But it says here, U.S. housing market posts worst spring selling season in 13 years. Why is this happening? Well, because long-term yields, treasuries have remained quite elevated, and that has translated into higher mortgage rates. So there's very little activity going on in housing, because people who fix their mortgages for 30 years, let's say, or less, during COVID, when rates were artificially low, a creation of the Fed, of course, they don't want to sell their house and refinance at a much higher rate. So the market is kind of stagnant. And I think the Trump administration, a little bit like the British have been doing for decades, he's trying to goose up the economy through real estate. And why not? I'm not saying it's a good thing, but that's the way Keynesians think, right? More debt to keep things going. So what else is going on? Well, we saw U.S. Treasury yields yesterday actually drop a little bit, 10 basis points. And I think it was related to this jobs opening number. And there are a lot of other indicators that are pointing to a slowdown. People are struggling to make ends meet in terms of the cost of living. Did you know that the BLS now is estimating 30% of the data for the CPI? So you can bet that CPI, or prices, are rising a lot quicker. And in the geopolitical side, there's still this negotiations going on with China vis-a-vis the tariffs. And I think Besant said yesterday that he let the Chinese know that they're not happy with China buying, I think it's 90% of their oil, or 90% of Iran's oil goes to China. I'm not sure, but China buys a lot of oil from Iran, and he's saying if you don't change that, we're gonna impose even more tariffs. We're gonna make it even higher. It could be higher, and we might not freeze or delay the imposition of tariffs. Of course, the Chinese responded that yeah, they're a sovereign country and that they'll buy their oil from whomever they want. And I think that could hurt treasury yields. And the rest of the world is moving away more and more from the dependence on the dollar. I'm not saying the dollar is going to disappear as a major reserve currency, but it's dwindling. And that means that foreigners won't have to buy as many treasuries. And that's why things are difficult. And at the same time, I'm not sure if the Fed cuts rates aggressively, whether that will help bring down longer term yields. And even if there is a deep recession, a lot of people expect long term yields to drop. But I think they could be wrong, because the big beautiful bill bet everything that the economy would pick up so that the deficits that it's supposed to translate into could be covered easily. But if the economy doesn't pick up and you've got this huge deficit and borrowing, it could be catastrophic for treasuries. Actually, it could be really bad in terms of actually yields rising instead of dropping. And that's where we come to the reset. It's the last card that they can't really play. And why do I say that? Well, because it hasn't been done since 1973, and we've spoken about this quite a few times of late with Clive Thompson and others, Andrea Cecchi from Italy, about gold revaluation. The Treasury of the United States and the Federal Reserve working together to change that statutory price from $42.22, which was set in 73, to whatever price they want right now. At 15,000, they'll raise just under $4 trillion. That's like QE that's not created by debt, right? It's a QE that's conjured up out of thin air. It is out of thin air, but it is, of course, backed by the supposed gold that the Treasury has, and the supposed certificates, the certificates that the Fed has for the supposed gold. And the reason this might happen again after 52 years, it's been 52 years, they don't do this regularly. They can't do this regularly because that destroys the credibility of the dollar and the credibility of policymakers if you keep doing this too much. Not that it won't destroy the credibility of the dollar if they do it again now. What it will do, I think it will boost prices. It will boost inflation, of course, because there's going to be more currency sloshing around. But at the same time, what they can do with this extra 4 or even more, depending on what price they choose, the Treasury could go and buy back the Fed's balance sheet, which is made up of U.S. Treasury securities and mortgage-backed securities. So the Fed's balance sheet maybe will go down to, let's say, 800 billion. Why 800 billion? Well, that's where it was before the great financial crisis, around that level. It went up to almost 9 trillion in 2022. It's now just below 7. So it would clear the Fed's balance sheet and all its losses. It would bring treasury yields and mortgage yields lower, interest lower. It would really liquefy the financial system. And yes, the treasury would have still a lot of funds to spend. The national debt would go down quite substantially. The deficit probably would come down maybe to 3%, maybe a little less, the budget deficit. Yeah, but the only downside I see in this longer term is that it doesn't really solve the problem of fiat currency and central banking, but it keeps things going. Yeah, it would be quite a sight. I mean, I don't think we've experienced that since, well, the early 70s, when they did a couple of revaluations in 72, 73. We saw what happened. We got like a stagflation environment eventually. But as for gold, I think even if they revalue it to 10,000 or 15,000, the fact that they do that will create a floor on the price of gold, and gold could go even higher on the market price. Of course, the Treasury and the Fed would have to stick to the statutory price, so they have to make sure that they have it at a level that really helps things out. So that's the only way out. It seems really extreme and unlikely, but I'll ask you a question. A lot of the things President Trump has done are extreme and really unexpected and unlikely, right? So, and even if this weren't to happen, I think it's more important than ever to keep a hold of your physical gold and silver, to make sure you have exposure to gold and silver if you haven't. I saw Ray Dalio, the billionaire hedge fund manager. He said that investors need 15% at least of their assets in gold and crypto. I mean, yeah, have crypto if you want. And it's funny because I've told you I'm staying out of crypto, but I was involved in Bitcoin and cryptos years ago. And actually, recently, I got news that one of my investments in a fund in crypto is actually going into the secondary market because up until now, all I can do is get dividends from that fund. I can't really sell the fund. So that's good news. And it's actually gone up 30 times since I put a little bit of money in there. I didn't put that much. That's the other thing with crypto. And I've told that to people many times in the past. Risk the amount that you're comfortable with. Yes, and by that I mean crypto is very volatile, and you could see the value of your investment go down very sharply. Of course, it could go up very sharply too, but it's not for the faint-hearted. So yeah, put an amount that you are willing to completely lose and won't make any difference to you. And that's what I did in 2016 when I put a little bit into this fund. So the fact that it's going to pay out and it's gone 30 times, it's nice. But at the same time, it wouldn't have mattered if it didn't pay out. So that's what I'm trying to say. So Yeah, people always want to know when is this reset going to happen. And this would, of course, be a government mandated reset. As I've said, and hopefully you've been listening since I've been posting on this channel, almost 10 years now, that the reset is ongoing, the market reset. And by that I mean every fiat currency, they're all sinking versus gold. That is the true measure of value and wealth, in my opinion, gold. But we could get some kind of artificial government mandated reset. And this is what I mean by the fact that I think we're very close to it. Yeah. Am I saying you should rush out there and get as much gold as you can? No, of course not. I'm still of the belief that gold and silver as well, they're like instruments for saving, for save your hard-earned income that you're able to put aside in fiat into real money, and you do it over a long period of time. So it's 7:25 a.m. London time. Let's quickly look at the markets this morning. I think yesterday things were fairly quiet. I think the markets are just waiting for the Fed's decision today. I don't think they're going to do anything, but who knows? But right now, gold is at 33.23, down a couple of bucks. Silver is down 11 cents at 38.11. Yeah, I think silver still is in an explosive like setup. I just saw this post here by David Lee. PSLV short volume spikes to 30 million shares. I mean, I've spoken about this before. These are the bankers, the paper boys. They're shorting PSLV shares to neutralize all the buying, so that the trust that runs this ETF doesn't have to go out there and buy physical. So they're desperate. And yeah, the stock market, as I said, is very quiet. It's slightly higher here. The indices, the currencies as well, they're not really going anywhere this morning. So yeah, I think we need to wait until, what time do they come out? It's 7 o'clock London time, 2 p.m. New York. The announcement from the FOMC. And then there's a press conference by the chairman, Jay Powell, half an hour later at 2:30 p.m. Eastern Time. And with that, I'm going to wish you all a very good day. Take care. Bye.